Now, why do most traders fail? Well, most traders haven't got a clue what the trend is, and so they're buyers and sellers markets and sellers and buyers markets. They don't know the targets. In other words, once they get a trade on, they don't know where it's going, so therefore they click it out with 5 or 8 pips and watch as it continues up 150. They don't have a system. Their system is, it's going up, I'm getting in. It's going down, I'm getting in. Okay? Or if they do have a system, they won't follow the rules of the system. All right? And traders are notorious, especially retail traders, for breaking the rules. Okay? Professional traders never break the rules. Retail traders always break the rules. They have poor risk margin management. So, why is it so important to limit your risk? Well, if we assume that there's a probability of a win or a loss on any trade we make of 50%, we put a trade in, we could win, we could lose, 50-50, okay? If we're risking 50% of our margin account, then we will wipe out as soon as we have 2 consecutive losing trades. You have a 1 chance in 4 of that happening, by the way. So the risk is extremely high. At 25%, you will wipe out as soon as you have 4 consecutive losing trades. You have a 1 chance in 16 of that happening. At 10%, you will wipe out as soon as you have 10 consecutive losing trades. You have a 1 chance in 1,000 roughly of that happening. Now, if you're honest with your trading and your trading record, you will probably be able to say, I have made 10 consecutive losing trades in a row. So you can see that 10% is way too high right there. Now at 5%, you will wipe out as soon as you have 20 consecutive losing trades. But you only have a 1 chance in about 1,000,000 of that happening. And at 2%, you will wipe out as soon as you have 50 consecutive losing trades. And you only have 1 chance in about 1,000,000,000 of that happening to you. So, somewhere between 2 and 5% is where a retail trader needs to be risking. That's the amount of money. If you find that you're trading pretty well, you're not in a funk, you're doing pretty well, then you might be able to push that 5% limit. But for most people, it's closer to the 2%. Okay? So why do most traders fail? Well, they cut their winners short and they let their losers run. So this is a little PowerPoint that I have set up here that shows you that with 30 pip stops, and taking X amount of pips, how good a trader you have to be. Now we use 30 pip stop as an average, okay? Every trade is totally different and stands by itself. And by the way, your stop is to protect your margin account, not the trade. But you have to use the parameters of this trade that you're risking money on to set your risk management. Okay, so the stop may be 34 pips in this case, it may be 27 pips in another case, it may be 44 pips in another case, but on average around 30 pips. Now the average retail trader in the market trades for only 5 to 8 pips. That's his average winning trade, 5 to 8 pips. So you can see here, using 30 pip stops, getting 5 pip wins, you must be 90% correct for the rest of your life if you're trading for 5 pips. All right? In other words, you have to be the greatest trader who ever walked the face of the earth, because there is nobody out there who can trade at 90% for the rest of their life. It's not possible. Okay? It's a market that's unto itself. It's not possible to get it right 90% of the time. All right? Now, on our charts, we have 30 pip T30s. They're 30 pip targets. And if you can just learn to get one of those a day, we have a saying in our company that a T30 a day keeps the job away. At 30 pips, with 30 pip stops, if you win 50 trades and lose 50 trades, you will break even. So therefore, you now only have to be right 51% of the time, and you will have an increase in your margin account. Okay? Now, we teach you, especially on a wild card, first trade of the day, in the momentum of the session, to trade for 55 pips. And if you can learn to do this, you now only have to be right 40% of the time. All right? In other words, you can lose 60 trades out of 100, as long as they're not consecutive, and you will still have an increase in your margin account. And the name of the game in Forex trading is to stack the probabilities in your favor. Nobody knows what the next candle is going to do. Not one person on planet Earth. Therefore, you must trade probability. Okay? So you have to stack the probability odds in your favor. This is one of the critical ways to do it. Okay? If you only have to be right 40% of the time for the rest of your life, and you can trade at 60% wins, then you will make all the money you need to make. It's not very hard. So your job is to risk. Okay? It's no different than the local grocery store guy. The local grocery store guy is going to go buy a container full of bananas. He knows when he buys those bananas, 10% of them are rotten when he buys them. But he still risks his money to bring in bananas that are only got a shelf life of about 5 days, and if he doesn't sell them in 5 days, he's going to have a loss. But he believes that he can sell that many bananas in 5 days. So he risks his money to make a profit. Same as what you're doing. Now, most traders will accept the reward of a trade, but very few will accept the risk. The difference between professional traders and retail traders is that pros spend all their time in the risk calculations, and retail traders spend all their time in the reward calculations, trying to find a great trade, as opposed to letting your margin management dictate what kind of trade to look for and when you can take it. So here's some examples of risking. If you have a $5,000 account, all right, 5% would equal a risk of $250. So if you decide that you're going to risk 5% of your account, you must accept a loss of $250, and you will have them, because no one can trade at 100%. So you will have $250 losses. If you cannot afford $250 losses, then you cannot risk 5% of your account. Now 2% is a risk of $100, about the cost of a nice dinner out with your wife or your husband. Okay? Now if you can accept that risk, and you have to accept that, then you know you will have losses of $100. And if you can't accept that, then what do? You break it down into smaller pieces. Instead of trading a mini, you trade a mini instead of trading a standard. Or you'll trade a micro account instead of a mini account, where you can manage the risk a little easier, and the amount when you're looking at your broker's chart, a broker's platform. Now once you know your risk amount, you can now find the other two pieces of the puzzle. Next is to define whether the chart will uphold the risk. And this will tell you how many lots that you can trade. Okay? So for example, 2% example equals $100. Now this could be one mini at 100 pip risk. So that's where you would put your stop, 100 pip stop. Okay? You risk 100 pips, which is $100. Or you could trade 10 micros at 100 pip risk, and you'd still end up with the same amount of risk. You could trade too many lots with a 50% risk. Okay? Or 20 micros at a 50% risk. You could trade 3 minis with a 30% risk. Or you could trade 30 micros at a 30 pip risk. None of those is greater than your $100 risk. And if you don't know that number, then you can't place trades and the proper amount of lots that you want to risk. So the important question is, what level does the chart tell you it will uphold for your stop? Okay? So if the chart tells you that a 30 pip stop is all it technically will hold, you cannot wisely put a 50 pip stop, since the probability is high that you will lose an extra 20 pips, which would break your rule. So you have to adjust your trade strategy, always lowering your risk, not increasing your risk. If you decide you want to make the trade and it requires a 30 pip stop, and you want to put a 50 pip stop, then you don't put your whole $100 on there. You put half of it on there. You see? So you reduce your risk to the level that does not break your margin management. Once you've defined your risk, you're now ready for the next part of the equation. The second most important question is, what target does the chart tell you it will potentially do? And if you don't know where the targets are, then you are destined to lose, because the name of the game is staying in until the targets get hit. Okay? So the minimal acceptable trade is 1-for-1 reward for your risk. Now 1-for-2 is better, and 1-for-3 is obviously better, but the minimum